In this episode, we're going to look at building your own pension. Even if you have a pension, stick around to learn how to build a second stream of dividend income. I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 4 topics. First, we'll take a look at what is a pension. Then we're going to take a look at, are pensions safe? Are they going to be around for a long time? And then we'll take a look at building your own pension. And then lastly, we're going to take a look at how much can you earn if you were to go ahead and build your own pension. So let's get started with our first topic. What is a pension? So a pension plan is designed to provide you with retirement income. Typically, the employer and the employee make regular contributions to the plan. The longer the employee works for the company, the more money they will receive in retirement. And you can only receive income from the plan during retirement and not before. And pension plans must be managed responsibly by the employer to ensure that the retirees receive the income that they were promised. So essentially, I think most of you are familiar with what a pension is. It is a plan that is set up typically by the employer to collect money from its employees on a regular basis, like every paycheck. There's a certain amount that's taken off. The employer may or may not contribute additional funds to that plan, and then that money gets invested to be paid out once you hit retirement age. So what do the pension plans invest in? So typically they invest primarily in stocks and bonds. And they've done that traditionally for a very long time. Now they are increasingly starting to invest in a variety of asset classes, including private equity, real estate, infrastructure, and securities like gold. And even some of them will invest in hedge funds as well. So there you have the potential to make more money, but there is also the potential for higher risk. The goal of the pension plan is to make sure that it's generating enough income, and that could be from capital appreciation, could be from dividends, could be from interest, and to generate enough income to be able to pay all of the retirees that are entitled to payouts from this pension plan. So how much money can you receive after you retire? So the pension income is going to be calculated using a formula. Every company has its own formula on how to do that. The formula might, of course, consider the number of years that you were employed at the company. So the longer you worked, then you'll receive more money when you retire from the company. And also the formula would consider either your final salary or the average salary during the time that you worked at the company. And then of course there's going to be an accrual rate. So it's usually a percentage. So like I said, every company is going to have their own formula. If you work at a company that is going to give you a pension, then you'd want to get in touch with them. They can tell you what the formula is, and then they will tell you based on your average salary, based on how many years you worked at the company, this is how much money you can expect to receive when you finally retire from the company. Now, so there are some pros and cons to pension plans. So let's take a look first at some of the pros. So the retirement income is guaranteed by the company. And the company, the employer, assumes all of the investment risk. So you as an employee don't have to worry about when to invest, what to invest in, when to buy investments, when to sell. You don't have to worry about any of that. The company takes care of all of that on your behalf. The retirement income, like I said at the top, is basically it's guaranteed for life. So once you retire and you with good health, you could live to 20, 30, 40 years after retirement, the company will continue to provide you with a pension, retirement income. And the income is also adjusted to inflation. So over time, you can expect to receive more money from the company. And once you're retired, you no longer have to make contributions to the pension plan. Now, I say typically, that's in sort of 99% of the cases, you don't have to. There might be some exceptions out there, but like I said, most of the time, majority of the time, you will not have to make any contributions after you've retired into the plan. And your spouse or partner, again, depending on the specific details of your pension, your spouse or partner could receive a portion of your pension income when you die. So those are the pros of working for an employer that has a pension plan in place for its employees. Now, there are some cons to this. So the first one is that as an employee or even as a retiree, you don't have any control over the investments. The company takes control of everything. Like I said before, the company is going to decide where to invest, what to invest in, when to invest, what type of investments to put the money in, and the company will decide when to buy and sell those investments. And so there is also a lack of accessibility. You are not able to access any of your money in the pension plan before retirement. And you could, here's another con, is you could receive less money if the employer experiences some financial difficulties. And the worst thing is if a company was to go bankrupt, you could potentially end up getting nothing. And we've seen that happen in the past where companies that have been around for a long time went bankrupt and the pension plan just gets shut down. So there are some cons to this. Let's take a look at our next topic, which kind of leads into some of the things we just talked about. Are pensions safe? Are they going to be around for a long time? Are they going to be around when you retire? And are they going to have enough money to pay you in retirement? And for most people, like I said, with good health, the retirement could last 20, 30, 40 years. So let's take a look here. So pension plans are generally very expensive for employers. To run the plan, you have to have staff, you have to have investors, financial analysts who are going to make those decisions on what to invest in. So generally, they are expensive for the employer to maintain and run a pension plan. And because of this, pension plans are becoming more and more rare. If you look at large companies, even in the growth companies, for example, Tesla, Google, Facebook, Twitter, even some of the high-tech companies like Cisco, these companies do not pay a pension plan. They might have retirement saving plans, such as a 401k, an IRA or RSP. They'll have those types of plans, but those are very different. They're not pensions. So pension plans are becoming more rare, unless, of course, if you work in North America, if you work for the government, federal or provincial governments, they have pension plans in place for civil servants when they retire. Also, I'm going to say law enforcement usually has pension plans in place. And there might be certain other types of industries, but they're rare. And it's becoming more and more rare to find an employer that has a pension plan in place. Now, the other risk here is that if the employer mismanages the investment, right? If they make the wrong decisions when it comes to what they're investing in, the pension could be at risk, or the payments could be negatively affected, right? So you may get less money than what you thought you were going to get when you retire. So that's a possibility. And like I mentioned before a couple of minutes ago, if the employer goes bankrupt, then the pension plan could definitely be at risk. So then what's the solution? How do you protect yourself? How do you make sure that you're in retirement, that you will be financially secure? So this episode is not only for people who don't have a pension, which is going to be the majority of listeners. It is also for people who do have a pension, and you can take what you're going to learn in today's episode and build yourself your own pension. And that could be a second stream of income in retirement. And so then if the company ends up going bankrupt or they mismanage and they end up paying less, you have a secondary source of income that you manage and that you control. And we're going to see that it's not rocket science, it's not complicated. There's just a couple of steps to follow to be able to build for yourself your own pension plan that's going to pay you on a regular basis every year when you retire. So that takes us to topic number 3 in today's episode, building your own pension. So now, how do you do that? That's the biggest question on everybody's mind. And the thing is, we're going to do it step by step. So let's take a look. Step number 1, you want to make sure that you build an investment portfolio that's going to generate income for you each year. Okay, so now you might be thinking, well, how am I going to generate income? So there's a couple of ways to do it. You can buy a stock at a low price and sell it at a high price. That's capital appreciation. That's one way to generate money from your existing portfolio. I don't prefer that method because then you're having to sell your shares. You could have the money sitting in a bank account, sitting in a term deposit, or in a CD where you're going to earn interest. So the interest is the income that you're generating. That also is it's fine, but it's not going to generate growing income, which we'll see in a couple of minutes. So the other option, and the one I like, and I've been a dividend investor for over 24 years here, is dividend income. So a quick reminder for those of you that are listening to this episode for the first time, dividends are basically the company sharing its profits with you, the owner of the company, part owner of the company. So remember that when you buy even one share in a company, you are now technically part owner of the company. And as part owner, you're entitled to share in the profits. So those profits come to you, a portion of the profits come to you in the form of dividends. So basically, it's cash that gets deposited directly into your trading account. So if we take a look at this quick example, let's say a company is paying a dividend of $1 per share. You own 1,000 shares. You'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend of $1 per share. And so you can spend that money if you wish, or you could reinvest it into other companies that are paying dividends. And that's a great way to grow your dividend income. Now, we're going to take a look at this later in the episode, and you'll see that share prices go up and down all the time, but it does not affect the dividend. The dividend is paid based on the number of shares you own. So that leads us to the next little piece here, which is dividend yield. And it's really simple. It is the dividend divided by the share price. So if we take an example, let's say the same company is paying a dividend of $1 per share, and the share price today happens to be $20. If we take 1 divided by 20, we express that as a percentage. You can see it's 5%. So what does that really mean? So let's say you were to invest $20,000 in this company, and the share price, like I said, is $20. 5% of $20,000 is $1,000. So you would receive $1,000 every year in dividends as cash. It gets deposited directly into your trading account. So another way to look at it is that you have $20,000 to invest. The dividends are, the share price is $20 each. You're going to be able to buy 1,000 shares. So if we take 1,000 shares, multiply that by the dividend of $1 per share, you end up with $1,000. So either way, we end up with the same amount, $1,000 in dividends every year. So the dividend yield is basically the return on your investment while you hold on to those shares. Without the dividend, there is no return on your investment until you sell those shares. And what happens if you buy stocks that don't pay dividends, and when you turn 65 or 75 and now you need the money, If you sell those shares and the share price happens to be down, we're in a market crash or a market recession, then you're basically going to be losing money. So the dividend is your margin of safety and it lowers your risk. Okay, so let's continue. We still have a couple more steps to look at. So step 2 is you want to make sure that you're building an investment portfolio where the income is growing each year. So you can see I've bolded that word on purpose. So not only do we want a portfolio that's going to give you income every year, we want that income to increase every single year. So how do we do that? We do that by investing in companies that have a history of increasing their dividend year after year after year. So I'm going to give you just 5 examples here. You can see them up on the screen. We can take a look at this. Coca-Cola has had 62 years of consecutive dividend increases. Colgate-Palmolive, 60 years. Johnson & Johnson, 62. Pepsi, 52 years. Walmart, 51 years. So that is an impressive track record. Think about how many market crashes, how many market downturns we've had in the last 50, 60 years. But yet companies like these have continued to not only pay a dividend, but also increase it year after year after year. This is consecutive years of dividend increases. So every time a company increases the dividend, that's more money in your pocket. You didn't have to buy more shares. You didn't have to sell your shares. You didn't have to invest any more money. You just had to hold on to those shares and you would receive more dividend income than you did in the year before. So let's continue with step number 3. We want to make sure that we're building an investment portfolio that is resilient. So what do we mean by resilient? What we mean here is that regardless of what happens in the stock market, we're going to have market downturns, we're going to have recessions, because stock markets go up and down all the time. And this is the same whether it's in a pension fund because they're investing your money in stocks. It's the same if you're buying mutual funds, index funds, or ETFs because they're all turning around and buying stocks with it. And it's the same if you buy stocks individually. Stock markets go up and down. And so we do expect that we're going to have market downturns, we're going to have market crashes, but we want to build a portfolio that's going to be resilient. So what do we mean by that? It's going to continue to pay you dividend income every year and grow that income every year. Now, the value of the portfolio may go up and down, but what's important to us as dividend investors is the dividend income is more important than the share price itself. So let me give you an example here. Let's take a look at Walmart over the last 30 years. So you can see the stock price is represented by the blue line. And you can see stock prices go up and down all the time. And we can see periods of time where the stock price drops by $5 a share or even $10 a share. We see significant drops in the stock price and it goes up and down. That's fine. It's going to do that. But take a look at the orange line. The orange line represents the dividends. And you can see the orange line continues to go up. Has it ever gone down in the last 30 years? No. In fact, we showed in the previous slide that Walmart has had 51 years of consecutive dividend increases. So this is how you build a resilient portfolio. Regardless of what happens to the stock price, regardless of what happens in the stock market, companies like this will continue to pay a dividend and grow it every year. How do they do this when the stock price tanks? Well, the dividend is not paid from the stock price. The dividend is paid from the earnings. So as long as the company has a track record of profitability and the earnings continue to grow over the long term, then they can afford to continue to pay a dividend to the shareholders and to grow that dividend every year. Let's move on to step number 4. It's important to have a long-term perspective. You can't build a pension plan or a dividend portfolio and expect to make $100,000 in 2 years. right? That's not going to happen unless you've got millions and millions of dollars to invest. So you have to have a long-term perspective. The longer you stay invested, the more time the money has time to grow and compound. And the more time you have to reinvest those dividends, and the more time you have to take advantage of the dividend increases. So when we're talking about investing here in the stock market, same with mutual funds, index funds, and ETFs, you want to make sure that this is money that you will not need in 5 years or less. This is money that you're saving and investing for the future. So the longer you can stay invested, 10, 15, 20, 30 years, the better off you will be. So we want to maintain a long-term perspective. Why? Let's go back to the same stock graph that we were looking at for Walmart the last 30 years. If you look at just a year, like 12 months, let's just take a look at any 12-month period, or even any 24-month period, like a 2-year period, you're going to see that the stock price is going up and down. In 12 months, 24 months, it's such a small period of time where the stock price actually looks like it's very volatile. It just up and down. You don't know if the stock is going to continue to go down or go up. You can't tell that. But when you step back and you look at the last 30 years, you can see that the stock price has done really well. So the stock market, your investments are going to do better the longer you hold on to those investments. So maintain that long-term perspective. Okay, to summarize, step 1, you want to build an investment portfolio that's going to generate income for you each year. Step 2, we want to make sure that income grows every year. Step 3, we want to make sure the portfolio is resilient, regardless of what happens in the market. And step 4, have a long-term perspective. So how do you do this? It's easy to write all this stuff up on the screen, but how do you actually do this in practice? So how do we do this? We do it by investing in quality, dividend-paying stocks when they're priced low. So when they're undervalued, not when they're priced high, when they're priced low. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock, and how do you know that it's priced low? So for that, I've created what I call the 12 rules of simply investing. So this is your checklist. You're going to go through the checklist, make sure a company passes all of the 12 rules before you invest in it. If it fails one rule, skip it, move on to something else. So rule number 1, do you understand how the company is making money? If not, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with recent dividend cuts. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? Remember we talked about make sure it's undervalued. And so there we look at 3 things, the PE ratio, the PB ratio, and then we look at the current dividend yield compared to the average 20-year dividend yield. And then rule number 12, keep your emotions out of investing. So if you follow the rules, and we've got lots of episodes on this channel where we talk about the 12 rules of simply investing. Some episodes focus on just a single rule. So I would encourage you to go back if you haven't seen previous episodes. It's going to take you through some of the rules here, and so you get a better understanding of how to go about selecting stocks. For example, rule number 11, is the stock price low? I'd recommend go back and watch episode 1. In episode 1, we show you in detail how to figure out when a stock is priced low and when it's priced high. So it's going to give you all that information, and that's how you're going to get closer to building your own pension plan, your own pension fund. So then once you do that, how much money can you really make? That's the other big question on everyone's mind, and that is our final topic in today's episode. So we're going to take a look at that. Now, there's 5 things that we need to consider that are going to impact how much money you can earn. And so the first one is knowledge. You want to make sure you have the investing knowledge so you know what to invest in and when to invest. And you're getting that knowledge from this episode, from previous episodes, and that's what I do at Simply Investing, is educating, helping you to figure out how to become a successful dividend investor. So you got to have the knowledge. Without the knowledge, do not put your money in the stock market. Do not download any apps on your phone and start trading stocks without any knowledge. Do you know how to look up the payout ratio for a stock? Do you know how to look at the debt level? Do you know what the dividend yield is? Is it a quality stock? Is it not? All of this comes into having knowledge on how to invest and when to invest. So you want to make sure you've got that knowledge first. So watching these episodes, that's a good first step. Continue to learn about what to invest before you invest a single dollar. And the same thing goes for investing in individual stocks, mutual funds, ETFs, or index funds. So you want to have that knowledge. Number 2, keep your emotions out of it. That's rule number 12. I just talked about that. Keep your emotions out of it. You need to have the discipline to stick to what we're talking about here, to follow the 12 rules, the checklist, and you have to have the patience to ride out market downturns. So don't panic when stock prices drop. You have to understand this is normal, this happens, the market goes in cycles, so you have to have the discipline and the patience in order to be a successful dividend investor. Next is time. The longer you stay invested, the better off you're going to be. The more time you have, the better off you're going to be. And I've said this over and over again in previous episodes. The younger you are, the better off you will be when you start dividend investing. So don't wait. The longer time you stay invested, the more time there is for the dividends to compound and reinvest and earn more dividends. Next is money. So the more money you have, of course, the more you can earn in dividends. It's that simple. If you have more money to invest, you can buy more shares. If you have more shares, you'll get more in dividends. So generally, of course, when you're young, you have more time, not a lot of money. As you get older, you'll have more money, but not a lot of time. So time and money, of course, factor into how much money you can earn when it comes to what we're talking about today. And then, of course, it's the investments themselves. Are you going to invest in quality companies, or are you going to blindly invest in any company, any dividend stock? And, that's not a good route to go down. So we want to make sure, that's why we have the 12 rules. This is your checklist. That's going to help you stick to quality companies, companies that have a history of profitability, have a history of paying dividends, have a history of growing their dividend, and all the other 12 rules we talked about. That is going to be very important, right? It's not going to help you if you have the knowledge, your emotions are good, you got lots of time, you got lots of money, but you're making poor investment decisions. So all 5 of these things up on the screen are very important, and all 5 of them are going to help you become a successful dividend investor. So I'll just give you a couple of examples because we're talking about investments here. Here we're looking at the same 5 companies that I showed you before. We were looking at the consecutive years of dividend increases. Now we're going to look at current dividend yield. Now, this is accurate as of this recording. So when you watch this episode, of course, the dividend yield is going to change because stock prices change every day. And this is not a buy list because I have not applied the 12 rules to any of these companies. What I'm trying to give you here is just an example of what's out there and what are the typical current dividend yields. So Coca-Cola today has a dividend yield of 3.1%, Colgate-Palmolive 2.1%, Johnson & Johnson 3.4%, Pepsi 3.3%, and Walmart 1.2%. So the dividends will range anywhere from 1% or even 0.5% all the way up to 4, 5, 6%. So you want to make sure that you're not putting all your money into one stock. You want to diversify We've got episodes on that, on how to diversify your portfolio, but this gives you an idea of what you can expect to earn. Now remember, this is not fixed. When the company increases its dividend, then your dividend yield is going to change. Your dividend yield is based on the dividend divided by your purchase price. So the day you buy the stock, that is your purchase price. And as you hold on to that stock for the next 5, 10, 15, 20 years, your purchase price never changes. But the dividend, if the company grows it, is going to change. So the dividend yield based on your purchase price will grow. I have stocks today that I've owned for many, many, many years. And so my dividend yield based on my purchase price, some of the stocks are now paying me 18%, 16%, 12% a year in dividends alone. So you will get to double-digit returns just from the dividend alone, but it takes a lot of time. And that's why I said before, you have to have a long-term perspective. So now I still want to answer that question. How much can you earn? Now, like I said before, it's going to depend on how much money do you have to invest? How much time do you have to stay invested? So there's a lot of different variables in there, and it's going to be different for everyone. So I want to keep it simple. I'm going to show you one example in this episode. We're going to say our person is a 35-year-old working professional. Their current savings, total 401k, IRA. If you're in Canada, it's going to be your RSP, TFSA. Total, if we add up all of the current savings, and this is somebody who started working straight out of college, so they've been working for many years. They're 35 years old now. They've accumulated over that time, and if you've got a company employer matching program for a 401k or RSP, the employer's been contributing in there. So this person in this example is now sitting on $175,000 today. And they are additionally saving $5,000 a year additionally that they're putting into their either 401k or RSP or IRA, any of those accounts. And again, if you have an employer that's contributing to any of those retirement accounts, then you're not actually putting $5,000 out of your pocket. You're putting in a percentage of that, and the employer is going to match that. So in this example, we're going to keep it simple. This person's got $175,000 to start with, and they're now contributing ongoing $5,000 a year. So what I'm going to show you on the next slide is a screenshot from our Google Sheet. I encourage you to download it. I'll put a link down below in the description. There's no cost. We don't even ask for an email address. No information from you whatsoever. You're free to download a copy for yourself. And then I encourage you to try it out. Because of course, you're going to be at a different age than this example I'm going to show you. You're going to have different savings, and you're going to be able to contribute different amounts. So download the Google Sheet. You can try it out for yourself. It is a great tool to allow us to forecast how much you can expect to earn. So let's go on to our next slide here. I know there's a lot of numbers on the screen here, so don't worry about that. If we take a look at the first year as of this, current as of this year, 2024, starting balance is $175,000. This person is now going to invest another $5,000 every year, ongoing. And let's fast forward. We're going to go down 30 years. And in 30 years, you can see that this person is going to be earning over $86,000 a year in dividends alone. And the portfolio will be worth a little over $2.6 million. Now, there's a couple of assumptions here. I've taken the average dividend yield as 3.5%. So, of course, if you change that, and you can change that in the Google Sheet. In the Google Sheet, you can change the four numbers that are in the green cell. So you can enter your own values to see what the future would look like for you. And then stock price growth, again, we've put an average of 5% per year. So you can see that by the time this person gets to year number 6, they are now earning 5 figures in dividend income, a little over $10,000 a year in dividend income. Now, the other assumption is, of course, that they're reinvesting the dividends every year back into buying more dividend stocks. So hopefully this will give you an idea of what you can expect to earn. But like I said before, I encourage you to go download the Google Sheet yourself, plug in your own numbers, try out different scenarios, and then you can see where you can expect to be in the future, right? In this example, this person is going to, over 30 years, is going to earn almost $1 million in dividends if we add up all the dividends per year, right? And the portfolio is going to be worth over $2.6 million. So that is an example of how much you can earn if you want to build your own pension plan or your own investment portfolio. So remember to invest in quality dividend-paying stocks when they're priced low. And how do you know when they're a quality stock, and how do you know when they're priced low? Well, for that, I've created the 12 rules of simply investing. I'm not going to go through the rules again. They're up on the screen. We covered all of them in today's episode. So the rules are there as a checklist to help you minimize your risk, help you build a resilient portfolio, and generate growing income every year. So if anybody's interested, I do have the Simply Investing course. It's an online self-paced course. There's video modules. So we've got module 1 where we talk about the investing basics. Module 2, we go through the 12 rules of simply investing in detail. Module 3, you learn how to apply the 12 rules. Module 4, you learn how to use the Simply Investing platform. Module 5, I'm going to take you step by step on placing your first stock order. Module 6, building and tracking your portfolio. Module 7, learning when to sell, which is just as important as to know when to buy. Module 8, reducing your fees and risk, especially with mutual funds, index funds, and ETFs. Module 9, creating your own action plan. And Module 10, I answer your most frequently asked questions. I also have the Simply Investing platform, which tracks over 6,000 companies in Canada and the US and applies the rules to over 6,000 companies every single day. So you can quickly see which companies to avoid and which ones to consider. So if you're interested, you may want to write down the coupon code SAVE10, SAVE10. It's going to save you 10% off of the course and the platform as well. If you enjoyed today's episode, be sure to hit the subscribe button, hit the like button as well. We have a new episode out every week. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.